Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm speaking to you from New York City on this, the 26th day of May, 2020. Before I talk more about today's show, I do want to remind you of my good friend Chen Lin. What is Chen buying? What is Chen selling? You might want to consider subscribing to Chen's letter. He's had an excellent track record over the years in the biotech space primarily, but also in gold and in the energy sector as well. He's done very well in all three of those sectors, and a few others here and there as well. Chen Lin, and it's chenpicks.com. My newsletter is Jay Taylor's Gold, Energy, and Tech Stocks. You can sign up for that by going to miningstocks.com. You can call our office here in New York during regular work hours, 718-457-1426, 718-457-1426. And Michael Oliver is with us today, so we always like to tell you that olivermsa.com is where you should go for Michael's excellent work, and he'll be giving you a taste of it in just a few minutes from now. I do want to thank all of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel, and also encourage you to send along whatever thoughts you have about this show to questionsfortaylor@gmail.com, questions, the number 4, taylor@gmail.com. And our sponsors for today's show, they are the people that make this show possible: RN Resources, Great Bear Resources, Hannon Metals, Irving Resources, Novo Resources, and Sitka Gold Corp. Before I get started with today's show, I'd like to make a couple of announcements. First of all, the Virtual Metals Investor Forum that was held, there will be one held, I should say, on June 18th, and I will be participating in that one along with Eric Coffin and Gwen Preston, two other newsletter writers, and I will be inviting various companies to this forum as well. And in fact, a lot of very exciting junior exploration companies out there. So I'm going to be, I will advise you perhaps next week who those companies will be. Already there are a couple of them that are voicing an interest in coming along, but I like to pick and choose the ones that I feel offer the best opportunities at a given point in time. So I'll let you know next week which companies will be a part of my segment on June 18th. That's the Virtual Metals Investor Forum. You can go to miningstocks.com, click on the Metals Investor Forum banner, and just give your name and email, and you can have access to the live Virtual Metals Investor Forum that I'll be a part of on June 18th. The May 13th Virtual Metals Investor Forum, which I did participate in, that occurred. Well, on May 13th, and you can now listen to it. You can go to miningstocks.com. If you go down, just scroll down the front page to Economy in Trouble, Gold to the Rescue. Go down and read that. It's a very short article, and in that there are links to all of the company presentations from the May 13th Metals Investor Forum. Calibre Mining, Gold Source Mines, Klondike Gold Corp, Premier Gold Mines, and Rise Gold Corp were the companies that I invited to that event. Also, my own presentation, which I titled "It's Worse Than You Can Imagine." You can also listen to that. There is a link. Again, go to miningstocks.com and just go to miningstocks.com and click on and go to that article, and you can access very easily all those articles. I've titled today's show "Some Sunshine in the Midst of Gloom" from Richard Maybury. Richard Maybury, Quentin Henning, and Michael Oliver are my guests this week. How much of a threat is COVID-19 to your health? How much of a threat is a massive economic depression to your health and well-being? What is the geopolitical fallout with regard to rising tensions with China? What is the best way for each of us to respond to protect our families and those we love in the midst of an increasingly tyrannical U.S. government? Those are some of the topics that I want to ask Richard Maybury to comment on during the second half of today's show. And right after our first commercial break, in just a few minutes, Dr. Quentin Henning will be with us to talk about Novo Resources news today, discussing the discovery of another large area measuring some 10 kilometers by 7 kilometers that hosts placer gold at Egina, on the company's Egina project in Western Australia. I'm looking forward to Dr. Henning providing an update on what significance this new discovery might have regarding Novo's future at the massive project. That's the Egina project. The gigantic Egina placer field was deposited for millions of years, over a period of millions of years, from material eroded from the gold-hosted conglomerate rocks to the west. And that was the area that sparked the news in 2017 that caused Novo to be one of the hottest stocks on the planet. In my view, the Novo story is now better than ever, even though speculative investors may not be all that excited about it now. But just in watching this company day by day and the developments that are going on, in my view, Novo Resources is still one that you should be paying a lot of attention to. And we'll ask Quentin Henning to fill us in on the latest right after our first commercial break. But right now, I'm happy to tell you that Michael Oliver is with me. And thanks for joining me again, Michael.
Oh, good to be back, Jay. Interesting times.
Oh, very interesting times. You know, I hope you can help us make some sense of these markets, though, frankly, Michael, because, you know, it was around 11 o'clock this morning when I took a look at the markets, and as I was preparing for this show, gold was getting hammered. It was down about $17. The S&P was up 2% at that point in time. And this is happening in the face of what many believe is a very serious economic future for us. Some believe could be as bad or worse than the 1930s. Can you help us make some sense of today's market action? Or are we just foolish for looking at it at one day at a time?
I think it's foolish to look at it one day at a time, okay?
Yeah.
We say that in our reports over the last several months. Broadly speaking, the following has happened. Gold has been surging now for about 2 years, since the late summer of 2018. Down in the 1100s, okay? Mm-hmm. And it's come up through a price base that everybody could see in the mid-1300s and is now, literally $100, $200 short of the 2011 price high. There was a high in gold a couple months ago in the 1770s, and then we dropped back into the 1600s. Came back up recently and stopped $1 short of that high. Mm-hmm. Intraday, using a different contract, because the April contract that expired, we're now using June. And then we've gently pulled back. But basically, over the last month or two, 2 months basically, gold has gone sideways. If you'll stand back and look at it objectively, week to week, month to month, it's been a horizontal range of action, most of the action being above 1,700, but almost sleepwalking, sideways, meaning firm. Not breaking down. Yeah, it breaks down from a high, but it doesn't really go down anywhere. The bears must be very frustrated. Now, look at T-bonds. Same story. They surged explosively, peaking in late March, while the S&P was making a low. And then T-bonds went sideways in price, yield flat, like a rock. Look at the weekly chart of the T-bond futures going back 2 months. So while the S&P has had this great, glorious recovery rally that all the Trumplicans want to believe in, T-bonds have not caved, and gold has not caved, and yet those are the two markets that were the alternative asset categories for people exiting the U.S. stock market. Those asset categories did not cave when the S&P had its rally. So stand back and look at the week-to-week, month-to-month, not the day-to-day. Enough on that issue. Also, on the gold issue, just a price chart comment. It's extremely rare for a market to make a peak, pull back, come back, make effectively the same peak, and top. Normally when a market is dynamic like gold has been, when you make your high, you retreat so deeply that the next high is far below the prior high. You don't come back and gently kiss the last high gently and then pull back again. This dumb price chart stuff. But it makes some sense. We're waiting on the S&P to roll over again, and I suspect that's going to happen very soon. And I don't think we're going to get a panic out of the S&P going forward. I think we're going to get a glacial bear market. But I think that the T-bonds will resume upside and gold will resume upside when the S&P makes its rollover on that category. Another issue that I think is important that's underneath the surface and not talked about much is the Federal Reserve. Powell at least has some integrity, unlike Bernanke. Bernanke told us at the peak of the housing crisis that there was no housing bubble. He reassured us of that, 2007, 2008. Of course, there was one. He just didn't want to admit it. And then we had the collapse. Powell, on the other hand, is panicked, white-faced. You can read it in the text of his comments. You can see it in the comments of his other governors of the Fed making speeches. They are desperate that all actions that can be taken, and not just by the Fed, but by the government itself. In other words, drop the helicopter money, fiscal stimulus policies, checks to the states, and so forth. Interesting thought that we discussed before we went on the air, Jay, is that your son or a relative mentioned to you that it looked like Bernie Sanders had been elected, that the policies that are about to go into effect, and I don't care whether Trump gets reelected or Biden or some other alternative Democrat takes his place, Obama's wife, for example. No matter who gets elected, I guarantee that student loans are going to be suspended, forgiven. A guaranteed income is probably coming down the pike, and I wouldn't be surprised that income taxes are abolished next year, possibly even this year. Meaning the full helicopters beyond any conception are about to occur. Checks are coming. I don't know why they don't just write everybody $1 million check and end the whole thing, right?
No. Oh, 10 million or 100 million. What's the difference? It's only a number.
No more debt. No more debt. Okay. But anyway, we're living in the twilight zone. And the underlying fundamentals that cause this break are not the virus. The virus is merely an instigator. We've had 12 years of Federal Reserve, central government stimulus, and less than investment-grade rates. That anybody who is retired needs rates to, have a nice yield to retire on. Companies don't get a good yield. So they've denied rates. They've discouraged savings. And therefore, when an emergency comes up, consider a family, for example. If every family in the country had let's say a 3 or 6 month reserve of savings, they could effectively take a 3-month vacation, a 6-month vacation.
Right.
Then a crisis that lasts several months, they could weather it.
Right.
But they can't, nor can corporations. So, for instance, in the corporate debt market now, which is the new replacement for what MBSs were in 2007, mortgage-backed securities, the Federal Reserve is now buying corporate debt through ETFs, HYG, JNK ETFs, that's corporate U.S. debt, high-yield debt to support it. Well, this is the same thing they did at the discount window in 2007 when they allowed mortgage-backed securities of less than AAA grade to be brought to the window and effectively bought by the Fed or money loaned against them. They didn't claim it was buying, but in effect it was. The problem with that is what happens when a big guy like the Fed comes in to any market to stabilize it. He becomes, in effect, a monopoly force that totally destroys the market function of price expiration. And when you deny investors price expiration, you deny them reality. They're blind. And it could destroy that market.
Yeah. Well, of course, that's what the Fed's been doing all along with interest rates, has not been allowing the price discovery for capital. And so we've dug ourselves into such a hole, encouraging people to overspend, overinvest, to invest in bad things. And now the piper is going to be paid, I'm afraid. Well, just one more comment I'd like to make because we're out of time. But notice that J.P. Morgan was suggesting that the reason that gold has been rising the way it is because there is a growing lack of confidence in the Federal Reserve and in the banking system. Well, why not? Why would anybody? What you're saying comes to pass. There's no integrity left in the central banking system at all. It is breeding chaos, it would seem to me, Michael.
Absolutely. I think it's inevitable at this point, and I don't think a political outcome of the next election has any relevance.
It's going to make much difference, No. So, Michael, as I understand, when I was reading your work over the weekend, or maybe it was a few days earlier, basically you're suggesting, earlier you had said 1,700 would be the sort of the first real test for gold at sort of a resistance level, but then it would go much higher. But you're not suggesting any kind of guidance in terms of where you think it's going to go. And I think that makes sense because who knows how worthless the dollar will become. How many trillions upon trillions upon trillions of dollars will be created out of nothing to try to overcome this massive debt implosion that the Fed is trying to overcome?
10,000 an ounce, 100,000. Literally, it's beyond.
It doesn't matter, really, does it? Because it's not what gold is worth. It's the worthlessness of the currency, and that's always the way it is. When currencies go to the dustbin of history, which is certainly, that's always the way it's been. Fiat currencies don't last. The only one that does last over over long periods of time is gold. Michael, we're out of time. So much more to ask you. We got to get you back again as soon as possible. So thanks so much for being with us again. Always appreciated.